Equity markets have remained volatile in recent weeks, although have recovered from the lows of mid-February and are currently down just 6% in local currency terms and just under 7% in euro terms year to date. In addition to the concerns evident at the beginning of the year relating to global growth, further issues have contributed to the weakness and increased volatility in markets. In particular, there has been increased questioning about the scale of policy options available to central banks, concerns over risks within the banking sector, a focus on the negative implications of low oil prices, political uncertainties, and fears over a possible devaluation of the Chinese currency. On the economic front, data has generally disappointed during the first 2 months of the year, as highlighted in the Citigroup Economic Surprise Index for developed markets, which shows how economic releases have fared relative to expectations. In particular, manufacturing, service, and consumer sentiment surveys have been much softer over the last week or so, although hard economic data relating to labour markets and retail sales in the UK and US, industrial production in the US and Japan, and bank lending and monetary aggregates in the Eurozone have been better than expected. Overall, while global growth remains modest, it should remain positive within the low range which has been evident in recent years and prove to be better than currently discounted by markets. With regard to banks, some of the concerns relating to possible systemic risks similar to those in 2008 and 2009 appear overdone. Banks' exposure to the energy sector is generally in single digits as a percentage of loan books, with the majority of this being investment grade, which should limit the extent of credit losses from energy exposures. Access to funding and liquidity should not be an issue for banks, given the various facilities introduced by central banks to address this in recent years. Capital levels have risen significantly since the financial crisis, and in the absence of a recession, capital requirements across the sector as a whole should remain limited. There have been concerns regarding the impact of negative deposit rates on banks' net interest margins, but the ECB is aware of this and is likely to introduce a tiered system of negative rates which should limit the impact on margins. Overall, recent concerns relating to the banking sector also appear overdone. With regards to oil, through the early part of 2016, there was increasing attention on the negative implications of the continued sharp fall in the oil price related to the implications for credit quality within the energy sector, the increased risk of deflation across the global economy, anxiety regarding possible implications for the strength of overall global demand, and the possible negative follow-through to overall capex and industrial production. The oil price, however, has begun to show some signs of stabilisation, having recovered from lows in the mid-$20 per barrel in January. At these levels, many shale producers in the US are loss-making, while individual OPEC countries also face significant financial difficulties. Recent efforts by OPEC to freeze oil production levels have so far failed to cap production, but it represents the first attempt in 2 years to support prices and suggests OPEC does not want oil prices to decline further. Combined with evidence of falling oil production levels in the US, oil prices have rebounded in recent weeks and has been supportive of equity markets as it helps remove some of the negative feedback loop mentioned previously. A continuation of stabilisation in the oil price would be supportive of equity markets. With central banks' credibility having been damaged in recent months, meetings at the ECB, the US Fed and Bank of Japan in March are likely to be important influences on markets in coming weeks and offer an opportunity to re-establish some credibility with investors. Given the perceived increased downside risks to growth and particularly inflation, the ECB is expected to reduce deposit rates further and expand the level of asset purchases both in terms of size and length, and could possibly expand the types of assets bought. The US Fed is expected to pass on an interest rate rise in March, and given the dovish tone of recent Fed commentary, is likely to lower forecasts regarding the pace of future rate rises, while leaving open the possibility of rate rises in the second half of 2016, given solid underpinnings in the US economy. While the market reaction to the hastily agreed recent reduction of Japanese deposit rates into negative territory in late January, which was negative, the Bank of Japan could also announce additional measures and further cuts in the deposit rate and provide greater clarity around its thinking on monetary policy. The increased volatility in equity markets of recent years is likely to remain a feature for the foreseeable future. The UK Brexit referendum in June merely adds to this uncertainty, and with polls giving no clear guidance on the result, a very close outcome is expected, although our base case is currently that the UK will vote to remain in the EU, which would probably be positively received by markets. In China, the authorities continue to emphasise they will not devalue the currency and so avoid negative potential dislocations in global financial markets from the deflationary impact of cheaper Chinese imports and competitive threat to China's trading partners. Chinese monthly FX reserves, however, will be closely monitored to determine the possibility of any change in policy. To continue to stabilise and recover further, equities require reassurance on growth and earnings and confidence in both fiscal and monetary policy options, and we believe the emergence of some of these in coming weeks will continue to help markets recover their early year losses.